All right, we're live. Thank you so much for joining me. My name is Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's about financial education. Today, we're going to talk about the stock market, some deterioration that we cannot ignore taking place in the small cap stocks, which is actually now the first major stock index to go negative this year. And we see deterioration taking place across the spectrum from large cap stocks, small cap, mid cap. So we're going to roll the quick intro. We're going to get into a quick show, and I'm going to tell you exactly what's going on, the way I see it, and what the counter forces or opposing forces are that are pushing investors to do things that are shaking them out of their long-term plans. Here we go. All right, thank you very much for joining me. My name is Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. We're just getting started. If you have any questions about the content that we're talking about today, please hit me up in the comments. Ask away. I love hearing from you in the comments. It's a lot of fun, and it's the best part about doing this, and I love answering your questions. And if you do have a question, odds are others have the same exact question. So you're helping everybody out, and it's a great community to be a part of. I always appreciate words of wisdom, your favorite emoji, or words of encouragement in the comments as well. And when you give us a thumbs up, it helps the rest of your contacts see the good work we're doing here. And I put this content out every day. It's educational and no axe to grind with anybody, but it really is good stuff if I don't say so myself. So we're going to take a quick look at the major averages. Okay, pop myself up in the corner here. Dow was down over 200 points, recovered off its low, down about 74 points. Not a big deal. NASDAQ up 88 points. Not a bad way to start October off, right? Today's the first trading day of the first quarter. And before you know it, we're going to be heading into Thanksgiving. And the year is going to go by very quick, as it always does from here on. S&P up, fraction up 1/100%. Gold continues to struggle, staying in the 1800s. Oil continues to back off. It's been backing off a bit lately. I don't know if you noticed, but gasoline around Long Island is now where I live anyway, right? About 375, 385 in that range. Seems like it's starting to come down, like the peak is already behind us. And the VIX is 17. It was higher last week, so nothing overly crazy. I think the really important story, though, is not the stock market. It's the bond market. And let's just take a look at the bond market. Interest rates from 2 years and lower, so 1 month to 2 years, continue to be in the 5% range. You're getting 5.5%, almost 5.6% for a 6 month, a little over 5%, a little over 5.5% for a 1 year. It's important to take a look at this because this is where people are looking to put money when they decide where to allocate their investments, stocks, bonds, or cash. You're getting a pretty darn good yield in a very safe, stable place in T-bills. T-bills, I can say, are safe and stable. Can't say everything is safe. I could say stable. But the T-bills are guaranteed, backed by the full faith and credit of the United States. What is a T-bill? A T-bill is a treasury bond with a year or less until maturity. And for a year or less, you're getting over 5%, which is not a bad place to be. So if you're someone who's looking for dividends, you're buying dividend stocks because they pay 3 or 4 or 5%. Well, now you're getting 5% in a T-bill, and you don't have to worry about the risk to your principal because the stock market's going up and down. Think about all those people who ran into, especially boomers, who bought a lot of AT&T and Verizon because they thought the dividends were good. We've talked about that many times, that these dividends are not money good, that these companies are actually earning less than their dividends, and that these dividends wouldn't be sustainable. And as of course you can see, they've been cut, and that's why those stocks have tanked. 10-year yield 4.685. This is the highest it's been in about 17, 18 years. On a zero coupon, you're probably getting closer to 4.8 right now. So what a zero coupon bond means is if you put money into it, instead of collecting interest every year, like, your 6 months, every 6 months you collect interest, it's called a coupon. Instead, you would get all the interest accumulating into the value of the bond, so the bond would go up in value over time. But a 10-year zero coupon treasury would probably run you about 62 cents in the dollar, and in 10 years, it's worth 100 cents in the dollar, and you've paid taxes on the growth along the way. So by the time it matures, you're not paying income tax on it. There may or may not be some small amount of capital gain in it or capital loss, depending on the price you bought. But by and large, you are paying your taxes on the interest along the way, even though you're not really collecting interest. The value of the bond is presumably going up by whatever the value of the interest would be if it was a regular paying bond, and you get taxed on that unless you purchase it in an IRA or some other tax sheltered account. So these are the things we look at when you see interest rates go up. Okay, bonds compete with stocks, and it takes away the impetus to put more money into the stock market. And what we need right now is more money going into the stock market to get the market to go up. There's a few ways that the stock market goes up. Now, to say the most obvious thing, more buyers and sellers, right? But what creates more buyers and sellers? Well, sometimes companies do a lot of stock buybacks that shrinks the supply of stocks, which automatically means demand staying the same. All else equal, the stock market would go up. Also, you could have just investors flooding the market with cash, which is what happened earlier this year. So those are the two ways that can happen, where demand for stocks is either created or supply is reduced, which implies demand would go up. The other thing is companies could issue a lot of stock, and issuance and stocks have been pretty much very quiet this year. We had a few IPOs this year. One of them was Instacart, and the other was ARM Semiconductors, neither of which was particular blowouts. And the IPO market still remains ice cold, and these two IPOs did not shake it up and wake it up. All right, so let's take a look at a few other things that you need to know about. And I'm just going to go to the homepage here. Just bear with me 1 second, okay? I'm just putting a few things on the screen so you can see them, all right? All right, let's look here, pop myself up here. This is the S&P 500. Okay, this is where it is. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So the S&P 500 is up year to date 11.69%. Okay, that's the S&P 500. All right, it's backed off a good deal from how much it was up previously. Now, one thing you should understand about the S&P 500 is that it is a market cap weighted index. So, for example, Apple and Microsoft are about 7% of the value of all the companies in the S&P 500. So therefore, each one is about 7% value in the S&P 500 index fund. Whereas you could take a company with only, a small value that might only be worth 1/10 of 1% of the S&P 500. So the bigger the company is, the bigger of an impact it has on the S&P 500 index. It's like a tongue twister. So that's a market cap weighted index. On the other hand, if you made every stock in the S&P 500 equal, that would give a lot more emphasis, a lot more weight, no pun intended, to smaller companies. So let's say you took Apple and you made it the same size as, let's say, General Motors, for example. Then they both have an equal impact on their particular benchmark if you're to do that. And looking at an equal weight ETF, all right, of the stock market, this is going to be so interesting. I think it is. Okay, the Invesco S&P 500 equal weight ETF, all right, its year-to-date performance is down. It's down almost 1%. So the point is when you de-emphasize the S&P 500 stocks based on market cap and look at them all as equal, the result is not nearly as rosy. And what that tells you is there are a lot more companies struggling as far as stocks go than going up. Then at least then we realize, right? So that's one thing. And then you take a look at the Russell 2000 index. This is the biggest index that we don't talk enough about, but it's a small cap index. And just to give you an idea of what's in it, I'm going to make this bigger so you could see it. All right. The 2000 stocks in it, it's filtered, but the biggest company, I have it filtered here by market cap. The biggest company is worth $15 billion. You compare that to a $2+ trillion companies like Microsoft and and Apple. So these are much, much smaller companies, and after that they get smaller real quick. But it does have companies you may have heard of, like BJ's is in it, KBR. I don't know, a lot of companies we haven't heard of. The reason you would go into the small cap stocks is because sometimes small cap stocks could perform quite well. All right. So I follow this. This is marketbeat.com, and they have a list. It's updated in real time with all the Russell 2000 stocks in it and current prices. The point is the Russell 2000 benchmark index, I'm going to find that for you, just went negative for the year. So the S&P was up about 11%. The S&P equal weight was down slightly for the year. And the Russell 2000 is now down 0.25%. So what that tells you is you take out the top biggest 7 to 10 companies in the S&P 500. The market is not doing nearly as well as it looks. Now, this is not a new theme. We talk about this all the time. But when you start to see a major benchmark like the Russell 2000 go down, you have to wonder, is this a leading indicator telling you that there's more pain to come and it's going to continue, it's going to spread to other benchmarks, because the other benchmarks were looking much rosier 2 months ago than they are now. So we've got some deteriorating fundamentals. We've got deteriorating consumer confidence. We've had deteriorating earnings, although a lot of people think we're in an earnings trough and earnings should start to go up. I don't know what anyone is basing that on. We have student loan payments, which have to start being paid now this month. I'm not making a call whether if that's good or bad, or we should wipe out everybody's student loan debt, or $10,000 or $20,000 or something like that. All I'm saying is that you've got $1.7 trillion of student loans that have to start being repaid. That does take away from people's discretionary spending, and that is expected to hurt restaurant stocks and retailers, things like that. It takes money out of the economy, because now you're talking about $6 or $7 billion a month going to student repayments that was going into consumption. But it is a knock against the economy, whether you like it or not, for whatever reason it is. So we have that. We have the UAW, United Auto Workers strike with GM, Ford, and Stellantis. We've got a lot of things to worry about, and plus the impacts of higher interest rates from the Fed are really starting to take hold now. So as they start to take hold, it starts to slow down the economy. We see money supply growth is down. Cost of financing is way up, and anything you buy that is financing, whether if it's leasing office equipment, leasing a car, buying a house, the cost of funding is just more money across the board. These all conspire to weaken the economy. Student loan payments being paid back, and if that happens, it's a hit for earnings. However, if the market slows down enough, it could mean that the Federal Reserve is done raising rates, and it could get to cutting rates a little sooner than expected. So that could be good for stocks, and that should also help the economy. But here's the rub. Stocks are really not down all that much from their original highs when the Fed started raising rates. So we don't really have as much of a bounce to look forward to like we have in past bear markets. And it's tough to say if stable or lower interest rates are really going to have the same impact on the stock market. It should be positive, but I think it could be more muted this time around, only because the stock market, as measured by the major averages, just have not come down all that much. We have to watch what's going on, and it's going to take some time to finally, see what the winning argument is. In the meantime, we continue to invest for the long term. We continue to own stocks for long-term growth. We continue to have cash and cash equivalents for short-term funding needs. That never changes, which is why you never see me worrying about the stock market, because I make these changes in advance for my clients' well-being so that the money's available for them when they need to start spending it. Remember, the ultimate goal is to not just keep putting money into the stock market for your entire life so you can keep paying fees on it to your financial advisor. The ultimate goal is to eventually start liquidating the money and to make the money last as long as possible in retirement, and maybe even have a little left over to pass on to your heirs. Thanks for watching. It's been a great show, and I look forward to seeing you tomorrow. Thanks.